365, shake my hand. Welcome back, guys, to another video on our channel. This video is thoroughly quite different, honestly. It was inspired by something I've always wanted to do, just never had the time to do it. But I think I'll be making time to do this more, right, from the second week of September, right? So moving forward, I'll be doing that, and I'll explain with time how it's going to work. But just a quick story. There's a gentleman in Grahamstown called Uncle EG, and he's the one who put a couple of us together, back then and even till today. He's extremely passionate about crypto. I think he's a master crypto trader. He's such a nice, humble, kind man, and he actually put me on this path for Forex a couple of years ago. He would throw us PDFs. He would make us present on the WhatsApp group. What is leverage? What are pips? He taught us everything he knew, and I'm forever grateful to what Uncle EG did for me. So in this video, I got a random inbox, I think, on my Instagram of someone who was just genuinely asking for help. I mean, he was just genuinely asking for help. I could tell this was a genuine thing. He didn't want signals. He didn't want a quick fix. He just wanted to sit down with someone and assess what potentially he was going to, what he was doing wrong. And that's how we conducted this one-on-one. And that's how I do most of my one-on-ones with 365 students anyways. And so he's consented that I can publish this. And this is a one-on-one from his current trading history, and I'm sharing it because I think there might be a couple of things you can learn from it. There might be a couple of things that you're doing, right, that he's also doing, and then maybe him allowing me to share this might help you, right? But see, on the other side, today is the 6th of September. On my dashboard, my team has literally responded to every single person who's tried to register or has registered for the course, all right? So don't forget, we start tomorrow, the 7th of September, 18:30 p.m. Right? I'm making sure I tell you the right information. You can register and attend, right? And if you're not sure, is this even real or not? Will you even show up? Come for free, but just so you know, remember, early bird registration, the last day for early bird registration is on the 9th of September. So you will have to make up your mind by the 9th of September, or you might have to be removed, right, from the group, so that those who are continuing with the course can continue, because it's an 8-week course, but from the 10th of September until the 13th, right, that will be late registration, right? After the 13th, no one can register. Fundamentally, you've missed the first week of the course, right? And there's no one who's going to have time to come back and really make sure that you keeping up, because registering after the 13th means you're missing week 2, right? And personally, I don't think it's worth it. I don't think it's worth you coming, fundamentally, because you're going to be so far behind. What I do in the first 2 weeks of the course is to lay the foundation, not what is markets, what is a pip, blah blah blah. I start to break down supply and demand, institutional trading, how the banks move, and the way we track order flows and money just from day one. And so those first 2 weeks are very fundamental. We will be recording our sessions. For those of you who are going to register from the 9th of September or during the late registration period to the 13th, so that you have the weekend to catch up with the recordings of week 1. Then after that, we close it, and this is our last live intake for the year. If you guys notice, sometimes I just feel like not teaching for about 2 months, and I just pump information out on social media so I can focus on my own trades and my own company as well, right? The trading company is still going on while I'm doing the stuff. The academy is my way to give back, right? So don't forget, the course is 60% off, right? We did keep that promise, and it's applying to everyone. But that's for those who are going to register up until the 9th, right? So see you on the other side. I hope you do enjoy this video. I hope you learn something from it, and I hope to see you tomorrow, right, for our live classes. Shake my hand. Peace. Mic check, mic check.
Hello, can you hear me?
Hey, yeah, I can hear you now, man. How you doing?
I'm alright, thanks. How are you?
Not too bad, brother. Shake my hand, man. Shake my hand. Dude, what's your actual name? Because obviously that Instagram handle threw me off. What's your real name?
It's Luciano.
Oh, Luciano. Oh, okay. And where are you from, man? There's something wrong with network, not mine, maybe yours and your mic, because sometimes I can't hear you. I can see you're saying something, but I can't actually hear what you're saying.
Yes, yes, yes.
Sorry? Hey, sorry, you're breaking, my guy. I can't hear anything. Have you got, I think we've got audio problems. Okay, I can hear you now. I can hear you now. I was saying, where you from? Ah, gone. Back now.
I'm back.
Cool, cool, man. I was saying,
I'm back now. All right. I'm from Zim, Blues.
Oh, cool. I'm from Zim. Do you know that?
Yeah.
Oh, okay, cool, fantastic.
Yeah.
All right.
Yeah.
I'm actually happy I took this because normally I don't do one-on-ones for people who are not students. So this is actually quite nice. Right, my brother. What's good, man? I looked at your.
Yeah, I'm happy. I'm happy with you. Okay.
And how long have you been trading?
Since 2019 August. So yeah, so this should be the third year, right?
Yeah. All right. All right. That's cool.
By the
That's
end of the second year. Sorry.
yeah. To 2019. Yeah. Okay. Not too bad, man. And you know, when I was looking through the screenshots you sent me, what's your current trading strategy? Are you more support and resistance type of trader? Are you using indicators?
I'm using a combination of moving averages and more of a breakout strategy.
Yeah.
Like a channel breakout.
Okay. All right. Cool, man. Cool. Let's start, and then maybe if you have any specific questions, let me know any time while I talk. Just feel free to stop me. What I'm gonna do is I'm just gonna tell you what I've picked up. All right. And let me just explain this. Oh, sorry. And last question. Who's your broker?
XM.
XM. All right. All right. Cool. Cool, man. Now, normally, if I do a one-on-one like this, what happens is a student will send me a statement first. And I saw your message about how your broker was taking forever to send you statements. I don't know a lot about XM. I really don't. I just know I don't like them. I can't even remember why. But I just know I don't like them. Something must have happened in my life with XM many years ago when I started, because XM was my first broker 8 years ago, sorry, my very first broker. But anyways, normally students send me a statement, and the reason for that is statements print everything. So it'll show me absolutely everything. So what the one-on-ones are meant to do, if let's say you're a 365 student, you've done the course, you started trading, you're going live, and now I can actually keep track of who you are. Because in class, we can all agree we understand the rules and we're all going to be disciplined, but your statement actually tells me the true reflection of who you are. So in a statement, you get the date and time. So what time our positions open, right? All that stuff, little details, very important. But you also get open and close. So when did you open the trade? When did you close it? Which translates to entry point slash your stop loss and then your TP. And we know that a lot of the times traders don't actually get to their TP. All right, so that's why the close is important. A lot of the times traders close profits manually. They get impatient, they get scared, they just close. So I needed to see all this information so I can actually drum up what I would call a first stage diagnosis. Okay. The other thing about today's one-on-one is you and I don't have the same trading strategy. So one-on-ones also work best with 365 students because they're trading the way I've taught them to trade. So I expect, because it's easier to correct. Like, remember, we're looking for 1, 2, 3 in the market. Why did you do this? This is not 1, 2, 3. So you're using a combination of moving averages, which I don't know if you know this, but moving averages will just always summarize the markets into very high probability support and resistance points most of the times. That's what moving averages do, right? And you say something about breakout strategies, so maybe a breakout of a trend line or a channel, etc. Okay. And that's cool, man. That's cool. There's not enough time for us to talk about strategies tonight, right? Yeah. I'm more of a supply and demand trader, but I'm pretty sure for tonight's one-on-one, you will get some type of value, even if we just focus on your current, what's going on with this thing? Even if we just focus on your current strategy that you're using. But I'm just trying to paint the picture of how this would have normally worked for a 365 student. Right. So what I did last night, I looked at your stuff for about 2 hours last night, and then I think I had a break for 15 minutes during the day to recap my notes. I looked at all the positions you had opened and closed on that summary type of thing. And so, you know, before I give you my opinion, I just want to ask a couple of questions. Number one, why micro account?
When I started, I thought it would make it easier for me to manage my risk. So with the minimum, the smallest, smaller minimum lot size and all.
Yeah. All right. Okay. So this is kind of like more of your decision to risk less money or overall, essentially.
Yes.
All right, cool. And in terms of brokers, why XM? Is it just the broker that's suitable for you in Zim, or did someone sell you the XM dream, or is it just your first broker? Have I lost you? I'm saying why XM the broker? I've lost you, man. Well, I can see you're still there, but I'm not getting your audio again.
I remove a random pick.
Oh, okay. Random pick. All right, cool, man. Cool. All right.
Let's move a random pick. Yeah.
Okay. All right. Yeah. Let's talk about these two things first, right now, off the bat. And
okay.
Now, how do I say this? Everything I'm about to say is my opinion. All right. It's not advice. All right. You are allowed to do whatever you will do. But if you were a 365 student, my job is generally to tell them how I feel about what I'm seeing, and they're allowed to move however they want to move. If I open your screen grabs, let's go to screen grab number 3 or screen grab number 2. I'll show you a couple of interesting things about number 1. Just want to quickly see where I saved your stuff. Right, cool. So let's just assess this. And remember, my brother, there's no judgment. I'm just talking about what I'm seeing. I used to blow accounts. I've blown more accounts than you. So I'm just talking to you, hoping to kind of like give you the best set of help here, right? But if you look at this, and we just go. Sorry. All right. So now, if you look at this, and I'm hoping you can see one of the screen grabs you shared there. Your reason for using a micro account is to limit risk and exposure and all that kind of stuff. But the lot sizing you're using is extremely contradictory. Because micro accounts are so tiny that it's like so I found that interesting, because you see, micro accounts are like 1/100th of a standard account. So I understand why you need to use a standard lot size 2,00, 1,00, 3,00. I understand why, because you want to get some buck for your money. The problem with that is it self contradicts itself in terms of risk management and risk assessment completely. You are far better losing this money on a standard account using 0.01. What you're doing here on the micro account is you are, because it's a micro account in your mind, and because you actually believe that choosing micro was a better way to kind of like limit exposure to risk, you've become so aggressive. You're very violent, man. and you are paying the price. I was like, yo, I haven't seen such lot sizes in a long time in my life, because this is extremely aggressive. I must say, I mean, I can't do the maths right now. I mean, it's a lot of maths and it will take us forever. But roughly on a standard account, if I do 0.01 on a standard account, and let's say it's 100 USD account, right? So it's a pretty much basic account, 100 USD. You're looking at about 10 cents per pip, right? And a lot of traders don't like that, because that's not a lot of money. How many trades do I have to make, Leroy, to make a lot of money? And I understand all of that. The problem with the micro account is it's way smaller than this, but when you go and with these big lot sizes, you're actually losing almost the same as someone with a standard account of 100 US dollars. But when we do the maths, you're averaging per trade at about 0.03 on 100 US dollars, which is crazy. And the reason for that is when I teach people risk management, I always tell them 5%. When your account is small, you actually have to risk a little bit more, right? So 5% is normally fair. So let's say you got 100 US dollars. 5% of 100 US dollars is 5 US dollars per trade, right? And if you actually check pip size on most currencies, 5% of 100 US dollars, which works out financially to be $5, is using a lot size of 0.01. The trades you're taking are bigger than this, much, much bigger than this, because you're not losing on average $5 per trade. On average, you're losing about $10 to about $12. Yes, there's some times where the losses are like $4, $3, but on average, this is where your losses are. So again, I don't think this is working for you, because the mindset of risking less or being more protective of your capital is actually going against the grain completely. You are far much more better on a standard account where you are clear that you are going to have to babysit price to get this for a while until your capital grows. And you're also clear that when you lose, you're losing within these regions, versus using accounts like this with these type of lot sizes, but still popping losses like this, all right? This will slow you down. I feel like you need to be slowed down, because right now, I think the idea of a micro account just allows you to feel as aggressive as you want. The second dangerous thing that you're doing, and I'm not entirely sure if it's because it's a micro account or it's not a micro account, or it's just how you trade, I really don't know, is this. Most of your positions, you've got like, well, let's go. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, right? And it goes on and on and on. Like you've got multiple positions. Now, if you really think about it, this is standard size or lot size 2.00. So this is technically 20. You're on lot size 20 here, right? So it's that social media thing, and I've seen it. I know those fake gurus are always showing people results, and it's like Euro USD, buy, sell. But the reality is you're multiplying your rate of loss by a factor, sometimes a 10x factor, sometimes a 20x factor, sometimes a 5x factor. And that's dangerous, because you might as well just open one trade and say pound USD, and let's say it's a sell trade, and just be honest with yourself and say at 20.00 lot size, because that's what you're doing. You know, it just looks cooler because you've got all these multiple entries. And when I look at the times, all right, of when, so I'm just talking about screenshot number 2 for now, and then I'm gonna go to the charts on the same screenshot to show you what you were looking at when you took the trades, and what actually I would have seen, and then maybe we can bounce off some trading ideas from there. But now here's another thing which I find interesting. So these trades are not always taken at the same time. Some are, some are not, right? So all these things is what comes out in the statement. right? So you can see here on the 20th of January, you took your L at about 1:45, and then you took a break or you traded something else, or I don't know what happened. You came back after 5 days, same trade idea. I want you to understand this. You lost a trade, and then 5 days later, you came back and you could still see the same thing in the markets. All right. So now that's talking to your strategy. Whether it's your moving averages, your interpretation of what they're telling you. I mean, we could go on and on and on. But after 5 days of markets moving, you could still see the same trade idea. It was still a sell to you, right? And you took a loss there. At 09:52, you opened at 09:48, so just a few minutes apart. So that's that double trading, like sell, 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 sell. Another one again, 9:48, same trade idea. They all didn't work out. So 5 days ago, trade one doesn't work. You come back after 5 days, you try 3 times, it doesn't work. Your trading psychology is seeing a sell, right? There's just something incredibly stubborn about your strategy. It's telling you to sell, even though you know that within the last couple of minutes, you've lost, 10, 20, about 25 bucks. You lost about 25 US dollars. And then on the 21st, in between these trading days, same trading idea, right? And it just goes on and on. And in the morning, you try it, it goes on and on and on and on and on. And fundamentally, that means you've got a non-biased approach to the markets. Now, a non-biased approach to the markets is you either completely understand what you're doing and nothing can shake you, right? So no matter what news says, no matter what your favorite YouTuber says, if you see a sell, you're going in for a sell, all right? So you fundamentally commit to an idea. And I just want to quickly correct that. Most of the time, you're committing to unrealized profits, right? And that's dangerous. You are committing to the possibility of this sale, happening. So what I'm going to do now is I'm going to go to the charts. I actually did this trade for you on the charts last night, and then I made a few notes, and then because I was trying to understand what's your trading strategy, and what time frames do you use, by the way. That's the one thing I couldn't tell from all of this. What are your entry time frames?
Somewhere between, usually it's H1, H4, and D1. Yeah.
All right. And in general, with these type of losses, how long did you hold the trades for? Or do they hit your stop loss normally on the same day?
So I didn't get that.
So I'm saying, with this type of trades, how long do you normally hold the trades for, or do they hit your stop loss on the same day you enter? Can you hear me? Should I repeat myself?
Normally 1 to. No, I heard you. I'm saying it's normally between 5 to 10 days, I'd say.
5 to 10 days.
Yeah.
All right, cool, man. Cool. Thank you. Right. So what I'm gonna do now is I'm gonna plot. I'd already plotted it here. I'm gonna delete this, and I'm gonna delete that. I'm gonna delete this. I'm just gonna show you a couple of things on this chart. To just ignore everything else. Ignore everything. Do I need this? This was a signal I gave. It's fine. It's happened. We made the money. This didn't delete everything. Right. So what I'm going to do now is I'm going to go back to your screen grab, and then we're going to travel back in time. Right. We're going to kind of like assess what you were seeing on that day, etc., etc. So let's talk about this cluster on the 25th, because you took a lot of trades there. 1, 2, 3, 4, 5, 6, 7. So out of all these losses, 7 of them happened on the same day, on the 25th. You were up at 4 a.m., man. Look at this, 4:30. Hey, looking for that money. Right. All right. Cool. So I'm gonna go to the 25th. Hey, I understand. I'm going to go to the 20th of January on the chart, and then I'm going to plot these entries and your stop losses. Okay, so let's find the 25th of January on the chart. And by the way, this is how I normally back test myself or review performance or etc. So it's something I think you can do by yourself at some point. So normally I talk about trading clusters, but I'll end the session with that. So this is, I'm looking for the 25th of January. 12, 13, 14, 20, 23. There we go. So this is 25 January right there, right? So I'm just going to put an arrow. There's the arrow. Where's 25? There's 25. Right. So that's 25 January right there. And why I'm doing this is I don't want us to judge your trading based on what happened after. What I want us to do is to assess what you were seeing on that day, right? So what existed, what did not exist, and if you do that, boom. So the rest of the chart is gone, right? So this is you on the 25th of January about to place your trades, and then what we're going to do now is we're going to start to slowly assess your entry points. So I'm going to go back to the screen grab. And I'm going to just start to plot trade by trade. And we can't do all of them because it took me about 2 hours. But a couple of them will give you a sample idea because it's literally all the same stuff. Now, if I choose this one here, so let's start with the first number 25th here. We've got 1,37029 and then all the way to 1,37161, right? So this is where your stop loss got hit. I'm just going to go plot those levels on the chart. Right, so there we are on the chart. I'm just going to quickly get a horizontal ray. Now, horizontal line, because I want to show you why a horizontal line. Because you're using moving averages, so that these things are looking at collective data, 0.29. So that's the first plot on the chart. And then I'm going to just make this thinner. 1. It's style. I just want to make sure we can see it. What's a good color? Let's make it white. Right. So that white line there is your one of your inputs in the markets. Right. And then the second one. Coordinates. Right. The second one is 1,37161. So 1,37. Right. So this was one trade. Right. So 1,7361. We're going to change the color. That was your stop loss that got hit. Right. That's where you got stopped out. Red is the same. Let's make it yellow. Right. So yellow is your stop loss. White was your entry point. Right. So this is once again trade 1. And on this trade, you lost about $2, I think. Right. So this is the trade that we've just plotted right now. This one here. You lost about $2.18. Now, I want us to see what you are seeing, like, or what the moving averages are telling you. I actually don't use any indicators, so I won't even bother asking you for the settings, but I can tell you what the market was trying to show you at that time. So if we just go right across, so right now I'm on the daily time frame. I'm on the daily time frame right now. So there we go. Right. So between the white line, this is your entry point, this is your stop loss. So let's look at the white line. Your stop loss, number 1, is sitting at what a lot of traders would call a support or resistance, right? Which is slightly dangerous because it could kick you out and still go in your direction. So price could hit your stop loss and still sell, right? Because this was a sell idea. But this, I'm interested to see where the white line is historically on the time frame. Where are all the candles? There we go. Right. So you see these wicks here, right? Or this is like parts, you know, what would call rejection. So the markets were being rejected here, which normally likes to translate into support or resistance, just depending on how you understand it, right? So that's what your moving averages start to pick up. That on average, historically, markets have a memory. So once upon a time, this was a very good buying area. It was a good, because look, every time price came down, there was massive rejection from the buyers pushing price up. Remember? And so if that support breaks, it becomes resistance, etc., etc. So where you sell on the 25th of January, this is the market memory that your indicators and all that stuff is talking to you about, whether you drew horizontal lines or you didn't. Where are the candles? Why are they taking forever to load? So this is the one that we just did now. There's not a lot of data on this level. All right, so this is where they are. It's terrible weather where I am today, so maybe my internet is slow. But I'm assuming you get the point. I mean, I could go to the weekly time frame, then we could see a bit more quicker. Right, so this is the arrow. This arrow here, that's where you sold on the 25th of January. You can see where you sold, there's been a little bit of resistance historically, but not much. Interesting. That is really interesting. Right. Anyways, long story short, here's my problem with this entry. Because I'm a supply and demand trader, I never trade where retail traders look to trade. If a retail trader, if there's a resistance, and I know a lot of people are going to be trying to shoot that market, what supply and demand does is it tries to get you to start thinking like the banks, because the banks have bigger volumes. They pretty much own the market and they create markets. So they create a fake out, they create a sell trade, etc., etc. So when I look at my chart and I see that a lot of people might consider this place a good place to sell because there's a rejection here and then price broke through. So if it broke through this support, it's going to be resistance there. What happens is it creates a selling psychology, right? And the moving averages will pick that up. But if I don't see what I call a supply as a supply and demand trader, which is probably somewhere there, I'm not going to sell. And so what happened is on the 25th, all these trades that you were taking, your system, your trading strategy was now telling you that this uptrend was coming to an end. And I'm saying this to say, I want you to understand the logic. What's happening here is, despite the fact, right, imagine markets have been going up since the 21st of September. You see the date down there, 2020. It's just been pumping up, 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 up. And then you and your indicator show up on that day and you decide, you know what, let's just sell. That's what it looks like, right? You don't control the markets. You have a very small account. And since September, markets have done nothing but pump up, right? So eventually, maybe you're looking at channels or no channels. I mean, it's really ugly to draw a channel there. But my point is, it's a big gamble trade, because here you're just going against a lot of money. And unless the banks are ready to take profits from pumping since September, you are in the way, all right? And if we go to the daily time frame or H4 time frame, this is exactly what it looks like. You were selling literally, right, in the middle of an uptrend. Maybe you thought the uptrend was coming to an end and you were trying to guess that. I'm not entirely sure. But this is really never a good idea. So now let's draw some trend lines. Do you use trend lines when you trade?
Yes, I do.
All right, cool. So let's say there was something like this here. So somewhat of an upward channel, which would not be the nicest channel to draw either, right? Even according to basic channel stuff, there wasn't even a touch to this upward thing here, right? So all it was an algorithm system saying it's now time to sell, and there really wasn't a lot of evidence to back that up. We're on the daily time frame. I'm just going to press play slowly and I'll show you what happened. So you've been trying to sell that whole day, and the very next day on the 26th, markets bought out. So that's why all your stop losses were hammered, right? Because I don't think this trend had come to an end. So this is literally nothing to do with strategy right now. I'm simply saying, if it's clear as day that this is happening and you want to trade breakout strategies, then your rules have to be clean, my brother. You literally have to wait for a breakout. You literally have to wait for a breakout. you can't anticipate a breakout and get ahead of it, right? Because all that happened here was you got chowed, right? And you got chowed rightfully so, because all this market has been doing for 6 months, or September, October, November, December, for 5 months, right? Since January, is just climbing and grinding higher and higher. Because if you're going to buy, you want to buy low, right? That's generally what the banks say. You see how they're consolidating on this resistance, which means there are many retail traders who kept buying and selling here, and many retail traders whose stop losses kept getting hurt. Don't forget, the yellow line is where most of your stop losses were. All right, sometimes it would be at 1,3793, but really round about this area during consolidation. And this is the daily time frame. That's why I was asking, how long do you hold trades for? Because banks can do this. Banks literally can stall the market. Consolidation done. 1. This entire trend, consolidation there. 2. Right? It's an uptrend, but once in a while, they'll pause. They'll literally pause the market to do this. Once in a while, on daily time frame, they'll use 2 to 3 days, 2 to 3 days, 2 to 3 days, sometimes even 4 to 5 days, right? Keep consolidating before they make a decision to push higher. Every time there's a consolidation in the market that you were looking at, there's a decision. They push price low. Why would you push price low? To sell high. No, sorry, to push price low to buy low, right? Then they push it back up. Every time there's a consolidation here, they push price a little bit lower, and then they push it all the way back up. And now we've got another consolidation. You sold on the 25th. Let's see what happens next. Yeah, I'm just going to increase the speed of this thing just a little bit. Right, you're starting to get the formula. They consolidate to push price low, to pump it up. Right? Why? Smart money will always buy low. So I think you got stuck in whatever you were seeing here. And a lot of retail traders will tell you this was a resistance, yada, yada, yada. Market was consolidating, yada, yada, yada. Absolutely not. This is literally, when you see patterns like this in an uptrend or even in a downtrend, you need to imagine banks campaigning. So they're campaigning to call for more buyers, right? The only way markets can go up or markets can go down is if money pushes price to go up or down. The bank's main positions are always at the beginning of a trend. They will add, as price goes up or down. But most of the millions of the banks in this particular chart that you're looking at are at the beginning, because remember, we call them market makers for a reason. They create a market, which means most of their buy orders are down here. So now I'm just giving you some supply and demand pep talk, right? Buy orders are down here. What buy orders do is they create a trend. So then all of a sudden, when retail traders start to pick up patterns like, all of a sudden, the buy orders that the banks put at this level to start the trend, which are clearly now in profits, invite a lot of retail traders in. So now the banks are not under pressure anymore to buy. But remember, when I teach this, my introductory lecture, I always say, think of the price of bread. So let's say this is bread. Let's say you're looking at the supply and demand chart for bread. Banks bought bread at $1 down here. They bought 1 million loaves of bread at $1. And now they're literally watching the price of their asset, which is bread, going up. At this level, bread is $2. But bread is $2 there, not because the banks are still buying. Bread is now $2 because retail traders are entering the markets and buying, whether we're looking at support or whatever your strategy is. The fact is they created a trend, and now a lot of people are participating in the trend. Occasionally, the banks will step in, right? Every time there's a big dip in the market where price is about to crash, if the banks want to maintain all these beautiful profits, they'll step in and add slighter, more buy orders. So now imagine here, the price of bread is now at $6. 1 million. Remember, you bought 1 million loaves for one, so you've got a 1 million capital
invested here. But your return of investment at $1 for 1 million loaves, and now 1 loaf of bread is $6, means the banks have made 6 million. But now they're adding more buy orders because they don't want this to push down, right? So that's how we come and we start to plot trend lines. When we're plotting trend lines, it's not because the markets care about our lines. It's an admission that something happened at this level. Someone with a lot of money came to add more money there, right? And so what retail traders do is they start to believe that for sure, there is a channel. And every time this happens, some big investor in the banking sector might want to take a little bit of their profit, because again, imagine now your bread here is now worth 7 million. Your 1 million loaves that you once bought for 1 million are now worth 7 million. And then you came in on the 25th of January. This is what happened now to you. And you're looking at this chart, and most likely from whatever systems you're looking at, the indicators and whatever, this started to look overpriced. I'm pretty sure if you're using an RSI, I don't know if you know relative strength index, it was probably saying, damn, this thing is now overbought, right? It's now time to sell. And that RSI is itself a very dynamic type of moving average. And the moving averages and any other strategy like support and resistance were pointing to the same thing. But if you really took the time to study the charts, you would notice that after every consolidation, there's a pullback and a pump up. Consolidation, pullback, and a pump up. Consolidation, pullback, and a pump up. This was not going to be a different day for the banks. If they've been doing this since September, they have a plan. All right, they absolutely have a plan. And that's what supply and demand does. Our job is to actually get a trajectory of the market. So the first 4 weeks of my course, I teach people how to predict. And I hate the word predict. I teach people how to read the bank's targets. Because if I know that the banks actually are gunning for here, they want the price, their investment on a loaf of bread to be worth $12 million before they start to sell. It means you'll never find me selling. I'm going to be looking for pullbacks like this, etc., to buy into, because I understand where the bank's target is. Remember, the banks own the market, so they're not going to be random. Banks can't be random. They actually have an expected target, which they publish all the time. Those fundamental news, you see, look where you're selling. So now where you're selling, you actually start to realize this is crazy. You started to sell here, but there was no one willing to sell with you in terms of a market maker. These guys are actually looking forward to pumping this market a little bit higher or a lot higher. Like the last time this consolidation rallied for a lot of days. I'm sure we're now in the month of March. So you sold in January an asset that kept pumping upwards till the 24th of February, okay, until the COVID thing happened, etc., etc. Now this is now Corona reaction, and pound USD does well because of fear in the markets right there. Now look at your breakout strategy. You've broken out of the channel. It's bouncing. Look, it's still bouncing by that resistance area. Remember, this is your entry point and your stop loss. There's still that psychology here. And who's been fooled here? Retail traders who still believe that support and resistance work, or that those indicators are going to teach them something real. Because if this is it, and this is a breakout, and it's broken out of which structure? So remember, it's broken out of this uptrend. A lot of people think this thing is going to drop now. It's broken out of the structure. It's gotten back to a place where it used to be a resistance, right? All the textbooks tell us that markets have a memory, but is that what happened? Now, markets edge on, right? Edge on, edge on, edge on. So now everyone who tried to sell here, stop losses have been hit, and this trend is just simply been adjusted. Markets are literally climbing your typical retail trader trend line on the opposite end, but keep going up. And then eventually something happens. What happened? Look carefully, consolidation. And a big drop. overextended this thing up to there. There we go. And then you start talking about structures, higher highs, higher lows, etc., etc. And this is where we are today. This is literally where price is today. This is today's candlestick. Am I by myself? Oh no, you're still here. My brother, does that help you in any way so far? Did you actually see what's going on? Okay. And again, that idea of markets having memory, markets keep coming back to the same.
Not in my head.
Okay. All right. No, not a problem, man. Right. So this is something you're going to have to adjust. And so before I move on to other screen grabs, and just to tell you what I saw, I just want to quickly summarize a couple of things I think you need to work on. Number one, I don't think micro account is helping you. I honestly don't. And I understand. I once had a micro account many years ago with, I don't even remember the broker. I honestly, there was a broker though that was so popular with micro accounts. I don't think it's helping you. I understand if you want micro accounts to help you, you're going to have to respect risk management, which means you're going to have to be okay making 1 cent or 2 cents on that micro account, and you treat that as a live practice account, right? That's fine. But what you don't want to do is to create these serious, dangerous habits of creating pumps. When you create a pump, an artificial pump, using a big lot size, all right, number one, simply just for the sake of getting some profits back. But the problem is, if the analysis is wrong, if the strategy is wrong, if the mindset is wrong, it's just costing you 3 or 4 times more money than a standard account. If you do the maths, you're spending more on a micro account than you are with proper risk management on a standard account. So I don't think that micro is helping you. Number two, let's move. Let's move from that broker, my brother. I don't know what's going on there. I can't remember. I can't remember why I don't like XM, but just be careful. Does XM still offer bonuses and all that nonsense? Do you know?
Yeah, still does.
Yeah. Avoid brokers like that. Avoid those type of brokers who are try and avoid brokers who are so aggressive with you opening accounts that they're willing to give you 50%, 20%, $30 to start you off, etc., etc. A broker only makes money when you start to trade. All right. You want a very good broker. Now, most reputable brokers will want a minimum of $100 US. And I can list a couple. IC Markets, that's a good broker. It doesn't have a trading desk. All right. This is important. This is so important. Is it ENC or ECN? They've got a special name for them. Some brokers have the legal right. So it's not against the law. It's lawful. They have the legal right to trade against you. All right. And we cover this in my course, week 4. I think it's in week 4 or something of module 1, where we actually explain to you how it works. Not only can brokers trade against you, sorry, ECN or ECN, whichever is correct, they don't trade against you, right? That's why I'm saying IC Markets is a good broker, because they do not, I just want to make sure my notes make sense, do not trade against you, or do not have a trading desk, right? And this means they don't take trades against you. They're simply an exchange. Right? Their job is to get you into the markets. Some brokers have the legal right to track your trades and trade against you. And it's easy because they use algorithms, right? Algorithms, right? Algorithms track our data, follow everywhere, what we're trading, how we're trading, why we're trading, etc., etc. And what those algorithms do is they put us into 3 specific books. I don't know if you know about this stuff, but all brokers have books. There's book A, book B, and a hybrid book. Book A is for people who lose all the time. So if you're a consistent loser, if 80% of your trades are not profitable, and the 20% of your trades that are profitable, it's small wins, right? So price didn't even go to your TP that you set up, that the algorithm noted. You made profits because you panicked and you closed early. You made $3 here, $2 there, $5 there, right? All those traders go to book A. Book B are winners, consistent winners, right? These are the guys who know what they're doing in the markets. They're the so-called 5% of traders who actually withdraw consistently, all right? And then hybrid is just like 50% traders. It just depends on the week. Some weeks are good, some days are bad, etc., etc. So sometimes they win and they lose. Depending on which book you're in with the broker, based on your algorithm flow that your broker is following, they can create market conditions for their clients, all right? And sometimes if they don't create market conditions, they know who to take trades against. So imagine this, let me put it this way. I used to work on a trading floor in South Africa, Alan Gray, and there used to be one of my very first mentors. All he did, or not all he did, but for the longest of time, he knew who on the floor was a consistent loser. And their contracts were always 6 months. All our contracts were always renewed after every 6 months until you're a senior trader and you became a permanent, right? 6 months. And every day, losing traders, right, on the floor would announce what they're buying and what they're selling. That's how it works, right? So because like that wolf mentality, you know, that stuff that they make it look cool in the movies. A trading floor literally operates like that. Now, what my mentor did was he spent time studying all the new people, or generally the losers. And most of the losers were always the new people, most of the time. And if they bought a stock, so let's say, and Alan Gray is very much big on JSE, you know, the Joburg Stock Exchange, but also global stocks. So let's say, what's a global pop? Yeah, all right. So let's say if they bought Apple that day, he would automatically sell Apple. It got so predictable that he didn't even check, you know, the fundamentals or whatever. If these consistent losers who lose 80% of the times, 80% of the times are buying something, he would sell, because automatically there's an 80% chance that they are wrong. Does that make sense? And that's what a broker's trading desk does. After your first 90 days of trading with a particular broker, you have a profile. After your 90 days, some brokers work with a total of 120 trades. After your first 120 trades of first 90 days, whichever comes first, they have a profile. They now know which book you sit in. And you said to me, you've been trading since 2019. So they know you. They know you better than you know yourself. They know that sometimes you'll see a retracement in the market and you close out of fear because you're not sure if price is going to come back down. You're not sure. So you're going to close early so they can push price up. And I'm not saying to say they're targeting you. No. You and every other trader think alike. Everyone using moving averages is seeing the same thing. Everyone using RSI is seeing the same thing. Everyone who has taught support and resistance is seeing the same thing. It's millions of people who are in this situation, right? If we're to ask people to submit screen grabs like this, all of them would look very similar. And so all these brokers do is they just take positions opposite their clientele because it's almost an 80% shot that they're going to win. Granted, you have a small account. They don't have a small account, right? So they can actually, you know, put in a lot of money just to push you up. So apart from, I'm trying to remove a couple of things here, but everything is going. So I'm just gonna, right? No, it's not gonna work. Right, it's fine. Let's delete all of it. Right. So I would suggest you change brokers, and this is my recommendation for you. IC markets, they do not have a trading desk. AvaTrade, very good. Well, this one is tricky. This is good if you're a 365 student because we track order blocks, and it's my belief that AvaTrade prints all order blocks perfectly. IC Market does the same thing, and I like it, but just check, because you're in Zim and you're staying in Zim, just make sure that IC Markets will accept you, right? Because some, I'm sure they will. It's more American brokers that won't accept people in Zimbabwe because United States still has a sanction against Zimbabwe as a country. So something weird. So you can't get into Yugo, which is a good broker. Like I've tried, but because of my nationality, they won't allow me. But IC markets should work. Average Trade is a very good broker. Rwanda, very good broker. Let me pull my platform. There's one more that I like to give people who are starting. It's an FX something, but there's so many FX ones. I just want to get the right name right. So FXCM, very good broker. And remember, with FXCM, you can actually link this to TradeView, which gives you a lot of tools to do analysis. So I like it for that. I like it for that. Saxo is a historical broker, but it's based in America, so it'll be very difficult to actually get an account with them. And then maybe capital.com. Check out these brokers the next time you want to fund an account. There's nothing wrong with staying with your XM, but I'm just worried about the fact that you won't be able to break out of the mold, right? You might need to start a whole new relationship with a whole new broker that actually is still going to learn your patterns over time, or a broker that doesn't care about that stuff, right? A broker will just take you to the markets and kind of like deal with your exchange, right? Number 3, but remember, number 1 is drop the micro. This is number 2, change your broker. Number 3, I don't know how you're going to feel about number 3, but I think you need a new strategy. Now, this is the work, the real work you're going to have to put in. That stuff isn't working for you, man. It doesn't work for a lot of people. And I want to be careful how I say this, because it's not really about marketing 365 right now, but you're going to have to find a strategy that can leverage a win rate for you. So I don't know if you know this, but you can lose 70% of your trades in Forex and only win 30% of your trades in Forex and still be a profitable trader. And it's important I tell you this, because the strategy most of the time shouldn't matter too much. Even the bad strategy, if it's got windows, I know moving averages work. I've seen them. I know that if you really know how to read a good bounce off a moving average and it acts as a dynamic support, it works, right? It might work 40% of the time, 60% of the time. That's enough to become a profitable trader. The thing behind profitability is not only to do with the strategy, it's more to do with your risk to reward ratio. This is where you need to focus your attention, risk to reward, which is why I said when I was looking at TPs, because I don't have your full statement, I can't tell what your target was. I can't tell. What I do know from the screen grabs you sent me is, number 1, your stop loss is too tight. And the reason for that is your risk is too big, right? Your lot size is too big, so you're scared. You're scared of losing money, and you think that the best way to limit the damage is to have a tight stop loss, which actually results in you being stopped out all the time. You are being stopped out a lot. So we can't even get to a place where we can judge the strategy yet, because the way you are trading right now doesn't even allow us to really fully assess the scale of how profitable your strategy could be, because your stop losses are too tight, my guy, way too tight, right? So let's say you're trading support and resistance, or whatever it is. This is the resistance, right? So before it was a support, price broke in and then went up and it's broken out. And let's say this is you want to sell here, right? So which means you think price is going to come there, hit this line and drop. That's your sell. Your stop loss, you're going to have to start thinking in zones. So think about a support or resistance zone, right? So your stop loss is going to have to be somewhere here. Let's make this yellow. And I can't give it to you in pips. I can't tell you, it has to be 10 pips away or 20 pips away. I genuinely don't know. What I do know is you're going to have to learn to read structure. So I would look left. If you're not going to change your strategy and you're going to keep doing what you're doing, at least look left. The last time markets faked out, did you see me, right? When we started, I scrolled all the way back to see how many times price had come back, where the rejection was. The last time price came back to this red line, where it was supposed to be a resistance, and markets faked out and went up a little bit and then went down. This was potentially a liquidity rate. Markets were looking for traders' stop losses. There was a stop loss hunt. You need to find all of them historically where they've happened and then put your stop loss above that, right? So that way, the next time price comes into your zone like this and you want to sell again, you think it's a sell, okay, you have room for this to happen before you get stopped out, right? It's not an 80% win rate type of trade, but it will definitely start to help you reduce the damage that you're seeing right now. Because what's going on here is your entry point is right there, your stop loss is right there. There's just no room because you are scared. So in terms of trading psychology, as soon as I see that in the statements where someone has a tight stop loss, I know they're scared. You're scared to lose money. You've told yourself, this is my last 50 bucks. This is my last 100 bucks. I have to grow it. I don't want to keep depositing. So what I'm going to do to grow it is I'm going to have a big lot size to make a lot of money quickly, but I'm also going to have a tight stop loss to risk a little bit of money. And what happens is you never get to enjoy the benefits of a big lot size because you don't make a lot of money. I'll show you now. I'll show you what I mean from your screen grabs. Look at these losses. Look at this. So there's $3, $2, $10, $10, $3, $4, $5, $9, $8, right? So these are quite big amounts. Now let's see the few times your strategy worked for you and you closed in profits. Right? Playing the same game. $10, $10, $10, $2, $1, $1. Now, if you go back to risk to reward ratio, and this is what I was saying, it's the first thing you need to focus on. Risk to reward ratio, I don't know if you know about it, but I'm just throwing a lot of things that you can start working on right now. Risk to reward simply means I'm going to risk $1 in the market and I want to make something. And for me, my students, they know the rules. For me to take a trade, it's not just the strategy. I need to see a couple of things. All right, this is now here. This is aligned up like this. This is perfect. Now, what's the risk to reward? If I'm risking $100 US at this level, I better make 300. That's what 1:3 means. If I'm risking $10, so if my stop loss is going to hit me at minus $10, my take profit must at least be at a minimum plus $30. Because if I have 10 trades, let me show you why this is so important. Let me show you quickly. Right. Now, let's go back to what I said before. I said create a standard lots, a standard account. Right? Standard account. And I'm going to show you the maths behind proper risk management. And let's say you got $100 US. It's not a recommendation. It's just easier for me to do maths on $100 US. And I say to you, 0.01 is how we teach people to risk 5%. So basically, the rule is for every $100 US in your account, you use 0.01 per trade. So if you had $300 in account, per every trade at a time, right? To risk 5% of your account, you would use 0.03 because for every $100 US in your account, it's 0.01, right? But we're just going to stick to $100 in this example. Now, 5% at 0.01, I told you earlier on, and you can check for yourself, is roughly $5. Now, let's say you have the risk to reward ratio that you have right now. Let me show you again your current risk to reward ratio. Your current risk reward ratio looks like this. Every time you win on average, you're looking at about 10, 10, 10, and then it drops a bit, right? Which is fine. The problem is every time you lose on average, you're looking at about 10, 10, 10, $2. So to me, it cancels each other. This is 1:1. You're making 10 bucks, but there's a high chance you're going to lose 10 bucks, right? It's a 1:1 risk to reward ratio. Now let me show you what's going to happen to your trading account over time, right? So let's say you've got a risk to reward ratio of 1:1, which is what I think you have right now, right? So if you've got a risk reward ratio of 1:1, I want you to learn to trade in clusters. So now moving forward, you never take any trades without reviewing by yourself to say what's going on. So the first 15 trades, you stop trading. Just stop and open your screenshots and do a similar exercise to what I'm doing. I'm recording this thing for you. After you're just gonna drop me, I'll send you my number as well, dude. If you want that, I've got a public Telegram group. I don't know if you're in that or if you know about it, but if you give me your email address, I'll send you a copy of this recording if you think it will help you in the future. But trading clusters, and what I mean by clusters is after 15 trades, stop trading.
I definitely will.
Sorry? Did you say something?
I think I'll need this video.
Oh, okay, cool, man, cool. Right, so you're trading clusters, and what trading clusters means is after 15 trades or even 10 trades, let's actually slow you down. After 10 trades, stop. Just stop and do some basic drills, right? Am I making money in the last 10 trades? What am I doing wrong, right? How many trades did I open? You can only open 10, right? Not at a time. I'm saying after you sold today, maybe bought something tomorrow, after those 10 trades, go back and do what I'm doing with you right now. You will slowly start to pick up your bad habits, right? You will start to run a profile on yourself. But with a risk to reward ratio, we're going to say, let's look at the first 10 trades you're going to take at 1:1, right? And out of those 10 trades, let's say you lose 6 trades. No, actually, you take 10 trades. Let's say you've got a 50% win rate. That means 5 wins and 5 losses, right? That's what you got. You got 5 wins and 5 losses on this standard account of $100, but your risk to reward ratio is 1:1. What that means is after 5 wins, or rather $100 minus 5 losses, whichever comes first, it really won't make a difference, right? So let's say you get 5 losses. Well, 5 losses in this particular example will be roughly worth $5, because remember you're using 0.01 per trade. So whatever your stop loss is, that's the maximum you're losing, and you had 5 trades that went bad. So that means you lost $25 in total, right? That's fine, right? That's not bad. But your capital now used to be $100, so now your capital has dropped to 75 USD, right? But at some point in time, you get lucky next week and you have 5 good trades, 5 wins. The problem with your 5 wins, because you're cutting your profit so short, right? It seems to me after price moves a little bit, because it's 1:1 and you're using a standard lot size of 0.01 on a standard account, so not a standard account, let's say you're making $5 to $6, give or take, and you win 5 trades. That means as well, you only made 25 bucks. You've been trading for 2 weeks. The first week you lost 5 trades, you lost $25. The second week you started to win 5 trades. And now guess what? Your capital is back to $100. Your psychology is frustrated with you. You're not moving, right? All you've done is you've gotten lucky enough to recover the losses you've made. You haven't made any profits on these trades in 2 weeks, right? And so next week, by week 3, when week 3 comes, you're going to want to use big lot sizes. But let's say you start to develop a system where your lot sizing changes completely. Actually, for the sake of consistency, let's leave this as 0.01. Let's say you actually work out your take profit and you say, no matter what happens, I'm going to go for 1:3. No matter what happens, that I'm going to go for, which means your take profit has taken into account that if I'm risking $5 in a sell, I'm going to wait for price to drop to this next support or this next resistance. At least that will give me a win rate of 1:3. And if that trade that you want to take doesn't offer you a risk to reward ratio of 1:3, guess what? You don't take the trade. You find something else that will. So let's say you do the same thing after the last 2 weeks of the month, right? You take 10 trades, but now you've got a risk to reward ratio of 1:3. Your strategy hasn't changed, which means in this example, your win rate is still 50%, which means once again, you've got 5 wins in week 3 and week 4, right? The last 2 weeks of the month, and 5 losses. Here's the power of risk to reward ratio. If you've got 5 losses, once again, those losses don't change. It's $5 per loss, which means you had $5 and your stop loss got hit at $5, right? So that's the 5 by 5 equals $25. So you lost $25 again. The difference now is while you're risking $5 per trade, you are trying to reward or profit at 1:3, which means now for every trade you're risking $5, right? $5, but you're going for 1:3. So you're hoping to make $15 per trade. Does that make sense so far? I know I'm talking a bit quick, but I'm just gonna make sure you're following with me. You still with me?
Makes sense. Okay.
Okay, cool. Because your stop loss here is kind of like stuck at $5 no matter what. What we're looking for is that take profit process. So for every trade, this 3 here is your R&R, your risk to reward ratio. That's what this 3 stands for. That if I'm going to risk $5, I better at a minimum at least make 3. That means you're going to have 5 trades at least making $15, which is very different from the previous trades. Now that changes the game, because now, even though you lost your first 5 trades and you lost $25, which means once again, your capital has dropped, right? You're $100 and now your capital has dropped to 75 because you lost 5 trades. But because you're trading at risk to reward ratio, you haven't changed your strategy. You've just changed your discipline to your profit taking, and you've adjusted your stop loss range. All of a sudden now, because of risk to reward ratio, 15 times 5 is $75. So now you're starting to see capital growth, which is the most important thing for a retail trader in what I always call phase 1. Phase 1 for a retail trader is one of the most important things, because all you care about is profits. You want to see your account grow. Whether it's growing by $1, $5, it doesn't matter. You want to see less red, more blue. It's so important for your psychology, which means after another cluster, trading in clusters, another cluster of trading, right? All of a sudden now your capital has grown by $50. Trading like this with 1:1 has high risks. What happens if this is changed? At 1:1, what happens if you have 3 wins and 7 losses? Do you see how your account can't actually even come back to $100? But at 1:3, if this changes, if you actually have 3 wins and 7 losses, you have a better chance of staying afloat, because the trades that you actually want cover you the cost, etc. Now, if you do this with your trading account 10 times and then repeat 10 times and repeat 10 times, and you forget about the fancy stuff you've seen on social media, and you forget about the millions overnight, you forget about the big lot sizes, I promise you this thing will grow. I guarantee you, if you just rinse and repeat, you get your $5 where you need to get your $5. Over time, your account growth will look like this. The first 3 months are difficult. The first 3 months are painful, but 3 months later, you'll be talking about a 4-figure account. 6 months later, you're looking at a 5-figure account. You will have ups and downs, but a risk to reward ratio of 1:3 minimum, sometimes 1:4 is better. What works even better with a good risk to reward ratio now is strategy. That's completely outside the parameters of tonight's conversation. I'm not entirely confident that your trading strategy is working for you. I really don't see it pointing out the stuff that you need to see in the markets. It could be a question of maybe you don't fully understand what your own trading strategy is telling you, which is okay. But just now, from talking from my own experience, I know for a fact that it's supply and demand that yields the highest win rate in the markets. A win rate here is different from risk to reward. Risk to reward works for any strategy. You are just tailor-making conditions for the fact that when you have bad trades, that the overall account is not affected, right? It still grows. But a win rate talks about the statistics behind the actual strategy. Okay. So imagine having a strategy that wins 80% of the time, right? The strategy by itself wins 80% of the time, but together with such a strategy, having a good risk to reward ratio. That's what we do at 365. And that's the difference. Here, you might have a strategy that wins 50% of the time, right? And had maybe a poor R&R or even a good R&R, right? Your odds are still a little bit low, right? You're going to have a lot of downs than ups, essentially. So this is also going to need a lot of work. Your particular strategy, it will need to change. That's completely up to you. But I do think you will need to find something that works better. Fundamentally, I am against indicators. I've had this debate with traders all my life, and some traders believe no, it's not the indicator. You can change the settings. You can make the settings better. Yeah, nonsense is what I normally say to them. Indicators are designed to lag, right? They're just designed to lag, because the thing that those candlesticks, I don't know if you know this, but those candlesticks are simply printings of what has happened. We are not looking at the market live, the way we think we are, right? We're looking at what our brokers are printing of what has already been bought or sold. Any strategy, and I'm talking about all 300 and something, the ones that I studied, is all 300 retail trading strategies, all of them focus on the now. Where is price now? Is price at a support? Is there a dynamic moving average? Where, et cetera, et cetera, et cetera. And what you guys are looking at is what the broker has just printed. What the broker has printed is what has already happened. If something has already happened, it means the banks have already made money. They've already made money, right? What supply and demand does, right, the one that I teach, we literally teach people how to identify turning points in the market, which means we are going to go wait. We know where the trend is going to start or end. So we're going to go wait on the other side, so that when the banks start a new trend on any chart, we start with them, right? So we don't only do the trend is your friend, because that's all retail traders were ever taught. The trend is your friend. This statement is not complete. The full cliche of the market was the trend is your friend until the bend, right? The trend is your friend until the bend. Price is going up until it's not. And if you don't know how to anticipate the bend, right? If you don't know how to anticipate a turning point in the market, you're screwed, because you're going to be holding a sell here and then markets shoot up there. And then you're going to be holding a buy here and then markets shoot down again, because yes, there was a trend, but there was also a bend. And our job, or what we do best in the academy, is to always know where the bends are. Because number one, the bends will always give you a buy low opportunity if you're trying to buy, or a sell high opportunity. And so you won't get that type of sell that you're trying to do in the middle of a channel inside a consolidation. It will never match the rules of supply and demand, because price is going somewhere. And up until price gets to wherever it's going to maintain a trend until the bend. So I think you will need to really think hard about this idea of a new trading strategy that does a better job of anticipating, right? Market speculation is all about correctly anticipating where price is going. Retail trading strategies are very much focused on where price is now in the present. And where price is now in the present, without confusing you, is it's in the past, right? What the broker is showing you has already happened. It's in the past. You can't make a fundamental good trading decision about an area of value that no longer serves any purpose to the banks. If they've already made their money and they've left, right? There'll be market memory and all that kind of stuff, but you can see it didn't really hold a lot of water over time. All right, so man, I've said a lot of things. I have no idea if any of this stuff was helpful to you. This was a good run. When I saw the screenshot, I couldn't help but be happy for you. You must have enjoyed this day. Yeah? December, you're cooking here.
You have no idea.
It's working. Right. But you can see everything that I've said has remained consistent. Your profits are too small to sustain your strategy. Because if this had been a bad day, to think about it this way, if this had been a bad day, it would not be minus $3. It would be minus 10, minus 11, minus 12, etc., etc. And so when you get a good streak, because of how heavily you are in the market, you're very quick to close, right? And I don't know if this trend continued for a little bit longer. I don't know if it could have, well, maybe let's make this the last exercise before before my wife pulls me out for family dinner. I said it's just gonna be an hour. It's gonna be an hour. That's what I told her. Right. Let me find a chart without all these notes. So I'm gonna look at the same thing that we did with trade. I'm gonna look at your Swiss Japanese yen you're selling.
Let's go for it.
Just say that again, brother. I didn't get it. Please repeat.
Now I'm saying let's go for it. Before she calls.
All right. Blessings, man. Blessings, right? So let me just remove all the drawings here. Right. So the sale that you are very profitable on happened on the 3rd of December 2020. And I mean, I haven't looked at how you traded this particular chart, but I'm assuming you might have been able to make more, or maybe you got out in time. I don't know. Let's find out. So 3rd of December, 15. Yes, man, you're a risk taker, I tell you. Oh man, you are such a risk taker, right, my brother? Right. So this is where you are. So this is the 3rd of December, 2020. See this red candle there? That's the 3rd of December. So let's remove everything else because we can't judge you on what happened right now, right? What we just want to see what you are seeing. Right, and off the bat, I can already tell those indicators, support and resistance is key. Why am I saying this? You can see, right? There's this here, right? Markets rejected, then went down, right? Markets, there were weeks rejection, markets went down, reject down, right? Price broke through and then came back up, down, right? Look at that rejection. So on paper, you know, it's like, yeah, no, this strategy works. Well, you will see. Right, I'm just trying to see how many more touches we can find. We can find lots and lots. You'll see them on YouTube. Go ahead, guys. This is the holy grail strategy of Forex. Blah 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 blah. Right, you can see here the same level. Right, acted as a support. Right, and here acted as a rejection. Rejection wicks, then price climbed off just to drop down. And man, I could do this all day, right? All day. There we go. All day. There we go, etc. It goes on and on and on and on and on. Right. So I'm assuming whatever you were using to trade that day, the indicator, support and resistance, or whatever you were looking at on the daily time frame, it made sense because it looked like, look, man, it's now time to buy or sell. Now let's look at your entries. I'm going to delete this line that I put in. And the next line I'm going to put in is literally what you entered as, right? So the first one is 116785. So that's 785. So where the hell is that? Right. Oh, that's beautiful, right? Right at the top of that resistance, right? And then the next line, where I'm assuming you either got stopped out, I'm not entirely sure. Let's put it in. Let's just make it a different color so we know which is which. So one of them is your entry, one of them is your stop loss, right? So this is the white line. Coordinates, right? So the net is 116,588. Right. So the white line is where you entered, and the yellow line is your stop loss. And you can see naturally price kicked you out and went a little bit up there. Right. So you're looking at this thing historically, and you can see this white line is playing on this resistance, right? So whether it's an indicator or not, I promise you all it's reading is the support and resistance stuff, which is where every single retail trader is looking. And so all markets have to do, market makers, liquidity providers, is just to run a long wick like this, and they'll find everyone. They'll literally find everyone's stop loss that was hiding here. They'll literally take them all out because they know exactly what to expect. If you're going to use those free PDFs, those guys know those strategies in there. A lot of people go, I learned how to trade from Baby Pips. Baby Pips is for free, yes, but who sponsors Baby Pips? Like why would such a big resource be out there? Who is teaching millions and millions of people to look at the markets the exact same way, right? It's easier for me if I was a bank or a broker. If everyone understood charts in one way, I know that I'll find you and everyone here. Now, let's slowly see what happens next. So I think your cells work out for a little bit, right? Because look at this white line is you, and this is on the daily time frame. So you can imagine on the smaller time frames, there's a little bit of pips, right? This is you. This is what you ate, right? This little everything on the other side of the white line, the $2, $1, $5 wins, 33 cents wins. It was price dropping, right? Literally acknowledging your sell point here, which is the overall resistance. And then after that, you were quick to close. You just closed immediately, which I guess in hindsight was probably the smart thing to do. Because, well, what happened next is a little bit scary, right? Markets just pushed forward, just kept going up, and look at this. That's just crazy.
Yeah.
That is just crazy, right? Look at that. They're clearing any levels, any break of market structure, all the way there. They're completely taking out everyone alongside of them. But it's more than that, right? It's more than them simply. I'm looking for stop losses and stop hunts, etc., etc. These guys had a long-term direction, And this is what I want retail traders to understand. If you look, pause. All right, this is obviously happening now for a couple of days, years. If you just go to a bigger time frame like the weekly, we know that you sold somewhere here. You sold here short term and you took your profits. Right, somewhere, sorry, the chart gets very messy when I teach, right? So don't forget, you sold somewhere there and you were lucky because you closed early. But if I look at this chart from a higher time frame as a supply and demand trader, I know that price at the very least, well, remember I said it's nice to actually read market turning points. We will like to anticipate where is price going, and then we simply trade in that direction. Or we simply wait for where price is going to end up, and then we take our first trades there with the banks. But just looking at price here on something like as big as weekly, or as big as monthly, something as big as weekly or monthly, I can actually tell you or tell myself that, look, man, markets have a long way to go. Markets want to go a little bit higher, which means this sell, even though you made profit somewhere down there, that sell was never going to last long term or even medium term, right? Because the very next day, price exploded forward. Right now, market's job is just going to keep zigzagging, and you can see that's what they've been doing. This is where price is today. It's literally today's candlestick. But when I look back historically, price started down somewhere down there. sorry, man, chart's getting messy and disgusting, right? But if I look historically, price in general, since about 2016, this is June 2016, December 2018, there's a demand here, right? So since then, price has just been trying to consolidate and then push up, consolidate and push up. And so I'm in a long-term uptrend. Someone would make that argument, just looking at this chart there. And so because price does something weird, we always say this in the academy, price is fractal, and fractality in price talks about how markets align themselves. So you just think about this as a golden chain. There is big money in the markets, and the golden chain can swing left to right, but most of the time it will align. There'll be a clean link of money, right? And you see that clean link of money from higher time frames, right? Higher time frames let us know the long-term plan, because banks hold positions for up to 10 years. They'll take profits along the ways, they'll add more positions along the ways, but in general, they are positional traders. That's why they create trends, right? If I'm buying for the next 10 years in a bank and I put in billions and billions of dollars to turn those billions into trillions, I am holding for a long time, creating a golden thread of money. So once I start to align my trades, when I learn to read markets properly, when I start to sell, not because I'm seeing a resistance, but I'm selling because the banks are selling, and the banks have been selling, and the banks, sorry about that, there, and the banks are just going to continue to sell. Once I understand that about the banks and I start to follow this golden trend, even in my smaller time frames, my H4 daily, I am looking to be in line with the bigger picture. That's what fractality means. And that's the last thing you're going to have to kind of like work on. So just as a final recap, my man, this was supposed to be an hour. We've gone way over 1 hour, 40 minutes. I hope it helped you. But number one, get off micro. I don't think it's doing what you thought it would do. Number two, I think my opinion, not advice, completely up to you. I think you would change brokers. Number three, you need to work on your risk to reward ratio. You got to get to a place where when you win 3 at a minimum more times than you were risking to lose. That's got nothing to do with increasing your lot size, everything to do with how you read structure and where you set your take profit. And then number 4, you might need to consider a different strategy, right? A better strategy. You might have to consider that. Number 5, whatever that better strategy becomes, whether you join 365 or you don't, or you improve on your risk to reward ratio, whatever it is, you need to then learn to kind of understand the flow of money. So higher time frames. And you can't take trades on higher time frames because those zones are so big, they will kill your account. They cost way too much. What I'm asking you to do here is to learn to anticipate the true direction of price. And we get that from higher time frames. And then you want to trade in line with that direction on the smaller time frames, right? You want to try and trade in line with that stuff. And these are the main things I picked up from just seeing your screenshots. I mean, obviously, I don't have your full broker statement, so I can't really go into any deeper detail. I would obviously completely avoid opening several trades at the same time, right? You want to open one trade at a time because you know it's going to risk 5%, that's 0.0125%, and then you want to see that trade to its expected end. You want to make money off it, or you want to break even. You want to slow down losing all the time, right? And the only way to make that exercise simpler is your stop loss needs to stop being too tight. Stop loss too tight right now, right? You need to relax that stuff. The only way you can relax your stop loss is to fix your lot sizing. You're never gonna have a wider stop loss if you're risking 90% of your account per trade, right? It's not gonna happen. So your lot size needs to go down, right? If you can do these 8 main things systematically, you should be fine. How long do I think it's going to take you to work on this? This won't take time. This won't take time. This will need understanding, might take time. This is going to take a lot of time. If you're learning a new strategy by yourself, this is going to be the place where you invest the most time, right? This won't take time. It will just depend on your understanding of market structure. But this new strategy takes forever to master, right? When I teach people how to trade, by the way, my course goes live on the 7th of September. We're teaching live, so it'll be like this, like a Zoom thing. I'm live though, like literally 4 times a week. Friday will be a special day because I'll be doing wealth creation through cryptocurrencies, but the majority of the course will be Tuesday, Wednesday, Thursday for 8 weeks straight, teaching people a whole new strategy. And you can get it like that because I'm teaching it. But if you're doing it by yourself, it's going to take you a long time, and you must just be patient. Don't give up. If you decide to go at it by yourself, don't give up. But no, it's gonna require patience and discipline and consistency. Higher time frame direction, it will depend on the strategy you choose, right? To use. If you use something else other than supply and demand, support and resistance is there on higher time frames. This won't take time as well, right? Open one trade, you know, the risk stuff, stop using stop loss, all these things don't have to take time. What will take time is here, learning a new strategy. This is absolutely important because it shapes your perception of the markets. It really does. My brother, I think if you can work on these 8 things as a start, and let's say you choose not to become a student or whatever, me and you might need to have another conversation maybe 2 months down the line to see if there's any improvement, right? Unfortunately, we're trading slowly, surely. If you change your strategy or you kind of like, you know, and I say 2 months because that's how long it takes me to teach people a new strategy. So I don't know how much of a fast learner you are. Maybe pick up a new strategy, or maybe the same strategy that you have right now, you work on bettering it, right? And a couple of things to adjust. Stop loss reading, how many times should price come back to a support or resistance before that zone is invalid? Your moving averages, how many do you need to use on your chart? Which one is dynamic, which one has got confluence with other technical areas, etc. And then the other thing that you're not doing as well as you should is direction. In fact, all your trades, if you notice, pound USD, you sold, but you saw markets ended up buying. This trade here, Swiss franc JPY, the one where you made a lot of some money, you know, the whole day you were profitable, you sold, but you saw when I played the aftermath, the actual trend was a buy. So there's something you're not understanding about the actual direction of money. So that's the other final thing that you need to work on. And this is just from looking at your results from last night without the statement. The statement would have given me more things to point out. But maybe when you get it, you can let me know. But yeah, man, are you okay with this feedback? Are you? Did this help?
100%. 100%.
Blessings, man. Blessings. All the best, my guy. I will be, before I pass out, I'll just send you my details, public Telegram link, my number, and then I'll let Zoom convert this video, and then I'll send it to you tomorrow via Google Drive. So just send me a Gmail address, and I'll send this to you.
Okay, that's all right. I'll also send some follow-up questions via DM.
Perfect,
so
man.
I don't hold you for now.
Not a problem, brother. Not a problem. But thanks for your time, man, and thanks for. I'm so glad I did this because I didn't even know you're from Zim. I wasn't even sure if I should take it, but I was free, so I thought, why not give back? But yeah, appreciate your time, buddy.
Thank you very much, man.
Sure, man. Shake my hand one more time. Sure. See you around, eh?
Yeah. Cheers, man.
Cheers, sir.